Last week, inside the White House, America's most influential oil executive sat across from the President of the United States and deployed a single word that should alarm every American anticipating cheaper gasoline. That word was uninvestable. Exxon Mobil CEO Darren Woods looked Donald Trump in the eye after being pressed to inject $100 billion into Venezuela's petroleum industry. His response wasn't diplomatic hedging, it was a blunt rejection wrapped in corporate courtesy. And here is what makes this moment so consequential for the global economy. Venezuela possesses 303 billion barrels of proven oil reserves. That exceeds Saudi Arabia. It exceeds every country on earth. Yet, the man leading the world's largest publicly traded oil corporation just informed the president that the world's biggest oil supply is not worth a single dollar of exposure. Today, I am going to take you inside that gathering. I will explain why these corporations are resisting, what Trump is genuinely proposing, and why the disconnect between political promises and economic reality has never been more pronounced. This isn't simply about petroleum. It is about understanding what transpires when political ambition collides with hard arithmetic. Welcome to the Dollar Watch. Let's examine the numbers. So, here is what actually transpired. President Trump convened an emergency gathering at the White House. This was not a press conference, and it was not a standard policy briefing. It was a direct, closed-door meeting with the chief executives of America's energy titans. In the room sat Darren Woods from Exxon Mobil, Ryan Lance from ConocoPhillips, Mark Nelson, the vice chairman of Chevron, along with representatives from Spain's Repsol and Italy's Eni. Even Shell CEO Wael Sawan joined from Europe. The firepower in that room represented trillions of dollars in market capital. The administration's pitch to these titans was straightforward. Venezuela's oil industry has collapsed. The nation is now under new interim leadership following the January 3rd U.S. military operation that captured Nicolas Maduro. The United States has essentially assumed effective control of Venezuelan oil operations. And now, Trump wants American companies to flood the zone with capital. He is asking for $100 billion in immediate investment to rebuild the infrastructure, restart production, unlock those massive reserves, and in return, deliver lower gas prices for American families. That is the vision he presented. What he received in return was something vastly different. Darren Woods spoke first, and his words landed like a brick through glass. He reminded everyone in that room that Exxon has had its assets seized in Venezuela, not once, but twice. Their equipment, their facilities, their investments, all confiscated by the government without compensation. Then came the phrase that should be reverberating through every energy policy discussion in Washington right now. Today, it is uninvestable. Now, I want you to comprehend what that word signifies coming from someone like Woods. This isn't a man who avoids risk. Exxon operates in some of the most challenging environments on the planet. They drill in deep water. They navigate complex political situations. They have operated in conflict zones. When Exxon's CEO declares a country is uninvestable, he isn't being dramatic. He is reading from a spreadsheet that does not lie. And he wasn't alone in his skepticism. Ryan Lance from ConocoPhillips emphasized that his company is still owed nearly $10 billion from Venezuela's previous seizures. That is capital awarded by international arbitration tribunals, legal judgments that Venezuela has simply ignored. Exxon is owed more than $1 billion through the same process. So when the president asks these executives to invest fresh capital, he is essentially asking them to trust a country that still owes them approximately $12 billion combined. Consider that from a pure business perspective. Would you lend money to someone who already owes you a fortune and has shown no intention of repaying? Would you double down on a relationship where you have been burned not once, but twice? That is the calculation these executives are making, and right now, the mathematics simply do not work. Let me provide you the context that makes this situation comprehensible. Venezuela's oil story represents one of the greatest resource catastrophes in modern history. Understanding it explains everything about why these companies are so reluctant. In the 1990s, Venezuela was pumping 3.5 million barrels of oil every single day. They were an energy powerhouse. Foreign investment flowed in. Infrastructure was modern. Technical expertise was abundant. Then came Hugo Chavez. Under Chavez, Venezuela launched what they termed a nationalization campaign. Foreign oil companies were told they had a choice: accept minority partnerships with the state-owned company PDVSA or depart. Some companies stayed: Total, Chevron, Statoil, BP. They accepted reduced stakes and maintained their operations. Exxon and ConocoPhillips refused. They wouldn't accept terms that stripped them of control over their own investments. So, Venezuela seized everything: refineries, equipment, pipelines. Facilities built with American capital and American expertise were confiscated overnight. The companies took their case to international arbitration. They won. ConocoPhillips was awarded over $10 billion. Exxon was awarded over $1 billion. Venezuela never paid a cent. That was over a decade ago. Those judgments remain outstanding. Now fast forward to today. What does Venezuela's oil industry actually resemble? Production has collapsed from 3.5 million barrels per day to approximately 800,000 to 1 million barrels. That is roughly 0.8% of global crude production. That represents a decline of over 70% in less than 30 years. It is not just that they are producing less oil. The infrastructure itself is disintegrating. Equipment has been cannibalized for spare parts. Pipelines are corroded. Refineries are operating at a fraction of capacity, if they are operating at all. The technical workforce, the engineers, the specialists, the people who actually understand how to run complex oil operations, they have fled the country. Venezuela's oil industry isn't just underperforming, it is physically disintegrating. Industry analysts at Rystad Energy have run the numbers on what recovery would actually require. Just to restore production to 1990s levels would require approximately $183 billion over more than a decade. And that is assuming political stability. That is assuming legal protections. That is assuming a functioning government that honors contracts. None of those conditions currently exist. David Goldwyn, who spent years as the State Department's special envoy for international energy affairs, comprehends how these investment decisions actually get made. His assessment of Trump's $100 billion ask was blunt. He called it fantastical. Goldwyn explained that major oil companies aren't going to invest single-digit billions, let alone tens of billions, without three things: physical security for their personnel and equipment, legal certainty that their investments are protected, and a competitive fiscal framework that makes the economics work. Venezuela currently offers none of these. Now here is where this story gets genuinely complicated, and it is the part that most coverage is missing entirely. President Trump isn't just asking companies to invest in Venezuela. He is proposing something far more radical. He is suggesting that American companies won't actually be dealing with Venezuela at all. During the meeting, Trump told the executives directly, and I want you to hear these exact words: "You're dealing with us directly. You're not dealing with Venezuela at all. We don't want you to deal with Venezuela." Stop and consider what that means. The United States is claiming effective control over another nation's oil resources, not through partnership, not through negotiation with the sovereign government, but through direct administration. The administration has already seized Venezuelan oil tankers. They are establishing a sales process for Venezuelan crude, managed by American entities. Trump posted on Truth Social that Venezuelan authorities will turn over to the U.S. between 30 million and 50 million barrels of sanctioned oil, which will then be sold at market price with proceeds controlled by Trump. This is unprecedented in modern history, and it raises questions that nobody has clear answers to. Here is the first problem. Trump recently signed an executive order that prohibits U.S. courts from seizing Venezuelan oil revenues. His reasoning was that such seizures would interfere with American foreign relations and international goodwill. But think about that from the perspective of ConocoPhillips and Exxon. These companies have spent years in international arbitration. They won legal judgments. They were counting on American courts to help enforce those judgments to seize Venezuelan assets as payment for what they are owed. Now, the president has essentially declared those legal mechanisms are off the table. So, the companies that Trump is asking to invest billions are the same companies he has just told they cannot collect the billions they are already owed. You can see why the executives might be confused about the message. Ryan Lance from ConocoPhillips addressed this directly. He called for a complete restructuring of Venezuela's energy system, including PDVSA, the state oil company. He emphasized that the banking sector would need to help restructure Venezuela's debt and provide billions in new financing. In other words, he is declaring the entire framework needs to be rebuilt from scratch before serious investment is possible. That is not a one-year project. That is not even a 5-year project. We are discussing fundamental institutional reform in a country that currently doesn't have an elected government. And that brings us to the political uncertainty that hangs over everything. Venezuela is currently led by Delcy Rodriguez, who served as vice president under Nicolas Maduro. She is functioning as interim leader, but there is no constitutional process underway. There is no clarity on elections. There is no roadmap for what comes next. If you are an oil executive considering a 20-year investment, because that is what major energy projects require, you need to know who you are dealing with. You need to trust that contracts signed today will be honored a decade from now. Right now, nobody can provide that assurance. Let me give you a historical comparison that illuminates the challenge. After the invasion of Iraq, the United States made similar promises. Iraqi oil revenues would fund reconstruction. American military presence would provide security. International oil companies were invited to invest. Those companies were extremely cautious. Despite active U.S. military protection, boots on the ground controlling territory, production recovery took more than a decade. And here's the critical difference. Iraq's legal framework, while challenged, was still more stable than what Venezuela offers today. Iraq had a functioning government, flawed as it was. Venezuela has an interim leader, frozen bank accounts, collapsed institutions, and $12 billion in unpaid debts to the very companies being asked to invest. There is one exception to the corporate skepticism, and it is worth examining. Chevron never left Venezuela. When other majors pulled out, Chevron maintained joint ventures with PDVSA under special licenses from the U.S. government. They kept their equipment in place. They kept their relationships on the ground. They kept operational infrastructure functioning. Mark Nelson, Chevron's vice chairman, offered the most optimistic view at the meeting, saying Chevron could increase production by 100%, essentially immediately, and grow output by about 50% within 18 to 24 months. But here is what you need to understand about that claim. Chevron is playing a different game. They have assets in place. They have established operations. They are not starting from zero. Exxon and ConocoPhillips would be entering a country that expelled them, seized their property, and never compensated them. They would need to rebuild everything from scratch: physical infrastructure, workforce relationships, legal frameworks, security arrangements. Chevron can talk about quick increases because they are already inside the building. Exxon and ConocoPhillips are standing outside a building that burned down their previous investment and now wants them to rebuild it with no insurance and no lease agreement. These are fundamentally different situations, and lumping them together creates a misleading picture. So far, we have talked about corporations and governments. Let me bring this down to the level that actually matters: how real people are affected by this standoff. Start with American families. President Trump explicitly promised that investing in Venezuelan oil would deliver even lower energy prices to Americans. That was the selling point. That was the justification. Energy analysts are pushing back hard on that promise. Claudio Galimberti, chief economist at Rystad Energy, points out that break-even prices for Venezuelan projects are around $80 per barrel, while current global crude prices hover around $60. Even under the most optimistic scenarios, maximum investment, perfect execution, complete political stability, meaningfully increasing Venezuelan production takes years. The timeline for any Venezuelan oil reaching U.S. markets in significant volumes isn't measured in months. It is measured in years. Then there are the American workers. Treasury Secretary Scott Bessent noted that the administration might rely more heavily on smaller independent oil companies rather than the majors. He said, "I can tell you that the independent oil companies and individuals, wildcatters, our phones are ringing off the hook. They want to get to Venezuela yesterday. This suggests job opportunities for experienced oil field workers. But let's be clear about what high risk actually means. Security is unpredictable. Political violence is possible. Workers in these environments face personal dangers that don't exist in Texas or North Dakota." Let me bring this together with the 3 points you should take away from everything we have discussed. First, President Trump is requesting $100 billion in oil investment for Venezuela. The CEO of America's largest oil company stood in the White House and called that country uninvestable. That single word tells you more than any political speech about what the risk calculation actually looks like. Asking for new investment before resolving old debts defies basic business logic. Second, Venezuela possesses the world's largest proven oil reserves, but currently produces less than 1% of global supply. The $100 billion figure isn't ambitious. It is disconnected from operational reality. Political ambition cannot rebuild corroded pipelines or train departed engineers. Third, American consumers should not expect lower gas prices from Venezuelan oil anytime soon. This isn't pessimism. It is arithmetic. Even under best-case scenarios, significant production increases take years. The promises being made today are creating expectations that cannot be met on any reasonable timeline. The core lesson here extends beyond Venezuela. Political will, even backed by military force, cannot override economic fundamentals. When corporations with fiduciary duties to shareholders refuse to invest, that tells you everything you need to know about how professionals assess actual risk versus political rhetoric. Markets don't care about speeches, they care about returns and risks. Right now, the risks in Venezuela overwhelm any potential returns. That is where things stand. I am genuinely curious what you think about this. Not about the politics, but the economics. Will any major oil company actually commit serious capital to Venezuela in the next 12 months? Drop your perspective in the comments. This is the Dollar Watch. We track the money so you can protect yours. Thanks for your time today, and I will see you in the next video.